Think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, 4 minutes to go until the bells ring. You can see we have green on the screen behind me. The S&P 500 up by about 0.4%, a little bit more on the NASDAQ 100, but of course, that's after yesterday's wipeout. So we'll see if sentiment can hold. Coming up after the break, a live exclusive interview with JP Morgan's Jamie Dimon. That's up next. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings. news.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Moments away from the start of trading, futures indicate a rally. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at the gains accelerating into the open right now. 0.5% on S&P futures, a little bit more than that on NASDAQ 100 futures. The small caps gaining about 0.2%. There you hear the opening bell down at the New York Stock Exchange and at the NASDAQ market site. You have a couple of IFF ringing the open bell at the New York Stock Exchange. Victory shares ringing the bell at the NASDAQ. If you look at the averages, we could make back more than half, or let's see, actually less than half of what we lost yesterday because we were down almost 1 full percent. So we have to add more than that to get back. And Katie, what are you looking at right now in terms of the live moves?
That was some good math on your part, and you're absolutely right. You take a look at the gains this morning, up about 0.5% when it comes to both the S&P 500 and the NASDAQ 100. Still a pretty large hole to climb out of. You consider the S&P 500 down 1% yesterday, but 1.2% on your big tech index yesterday. But of course, progress today. The Russell 2000, of course, joining in on the action, but to a lesser degree. The Russell 2000, your small caps currently higher by about 0.1%. Meanwhile, let's take a look under the hood, and we'll start with Supermicro, extending gains from yesterday after announcing it delivered 100,000 GPUs to power artificial intelligence factories. That's believed to be billions of dollars in orders. This is an interesting stock because remember, Hindenburg, which Matt will talk about in just a moment, shorted this stock a little while ago, and it's been a rough ride, but some good news for Supermicro. Meanwhile, let's also keep an eye on Pepsi here, which cut its revenue outlook for the year as higher prices across the country hurt consumer spending. Traders not really sure what to do with those results. The stock is currently, I'm going to call that unchanged, Matt.
All right, yeah, it looks pretty unchanged to me. Let's look, though, at one of the stocks you talked about earlier, which is being almost decimated. The definition, of course, reduced by 1/10. This is Roblox, plummeting after Hindenburg announced it's short of that stock. And as Bailey Lipschultz was mentioning, when Hindenburg puts out these reports, it profits off of a drop in the stock price. So it's trying to drive the price down. And right now, it is being successful. Let's take a look at some of the Chinese stocks also that suffered at the start of trading in Shanghai after a week-long break. Remember, we had that huge rally, and I think Goldman Sachs was out saying that Chinese stocks could go another 20%. But right now, we're looking at big losses for Alibaba, Yum China Holdings, as well as Baidu, because you didn't get the big government stimulus that we were hoping for. Bloomberg's Abigail Doolittle has a little bit more on the China moves for us. Abigail?
It seems we're back in an era of more, investors wanting more after the big stimulus just 2 weeks ago that sent China tech stocks up 30 to 40%. Today, down nearly 7%, the worst day since March of 2023. So pretty dramatic reversal here. We don't know how far it will go, but that uptrend, those buyers have been reversed. And here are some of the other losses. PDD Holding down 7%, Billy down about 13%. And then take a look at the casino stocks, the gambling stocks, both down about 4% or more. Of course, they have lots of exposure to Macau. So the idea that if more stimulus isn't going into the economy, it's not going to be going to the Chinese consumer who could then gamble it. Relative to the China tech stocks, this is the RSI, or a momentum indicator for that index. Yesterday, it had been close to 90 or really overbought. Well, the reversal's been dramatic. It is now no longer in that overbought territory, Katie, so we'll be keeping an eye on this and whether or not we're going to have a reversal similar to times past, right back down to oversold as they go up and then back down.
All right, Abigail Doolittle, thank you so much. Let's go now to London, where JP Morgan Chairman and CEO Jamie Dimon joins Bloomberg's Lisa Abramowitz for an exclusive interview. Lisa.
Katie, thank you so much. Really appreciate it. I am here with Jamie Dimon at the Techstars conference at the Novo Hotel in London. And we're going to get into a bunch of different things, a lot of the questions that people have. But one main question is, we're seeing this sort of explosion in tech. A lot of people are pausing it. How are you sort of seeing the advancements that are most important so far? And going forward, what's most exciting? What's the most exciting for you?
Yeah, so first of all, welcome everybody. Thrilled to be here. First of all, you got to look at tech in the big picture. It's been changing society for hundreds of years. With agriculture and printing and steam engines and electricity and the internet. And tech grows in itself. The internet caused A, B, and C, semiconductors, and Gorilla Glass caused the iPhone. And so this is just another wave. We're here in London because we call it the tech conference here, but it's also diaspora now. So if you went back 10 years, it was mostly in the United States and concentrated in Silicon Valley, Boston, New York. Now it's everywhere. We have a tech center in Berlin, Glasgow, Edinburgh, which I think is great. You have more innovation taking place. I think it's really important for Europe. And obviously the thing now is all about AI, which I think is real and is going to change an awful lot of things. Can I just mention one other thing?
Please.
There's always been a fear of tech that's going to take away jobs, but you got to look at the big picture. And sometimes it does, but in the big picture, it is why mankind has gotten better and better, lives longer, GDPs go up, productivity goes up, health gets better, work hours go down. So people have to keep in mind the benefits are huge. We probably have to find a better way to help the people get hurt by it.
So you talk about the people who are getting hurt by it, and in a previous interview you were talking about how it's going to reduce some jobs and it's going to create others. Yeah. Which jobs do you expect to get eliminated and which jobs do you expect to get created?
Yeah, we don't really know yet. We shouldn't put our head in the sand. We know it's going to be true. So a lot of jobs, your job will be enhanced. You'll get more research, more questions, you'll have like a real super assistant, chief of staff on your shoulder when you wake up. But you're still going to be interviewing people. Other jobs, it will handle, error rates or, it already hedges our trading equity floors. And it's already been used for risk, fraud, marketing. Hasn't really eliminated a lot of jobs, but it created effectiveness in terms of productivity by, reducing fraud losses. And then if it changes jobs in operations and elsewhere, we'll deal with it. We have turnover 20% a year. We'd love to retrain people, redeploy them, re-educate them. And so I'm not worried about it. And if it works for the customer and the client, we can kind of do more. That's the other thing. For a successful company, if you're growing and expanding, you're actually almost always getting jobs. So, to me, I want to have a successful company, and we'll deal with whatever the downside is of AI.
So I was speaking with another head of a major U.S. bank who was saying that he expects his bank to keep growing in terms of business, in terms of assets, but stay the same size when it comes to staff. Do you feel the same for J.P. Morgan?
I don't really know, to tell you the truth, and I don't try to predetermine that. So if you look at what we're doing, we're still opening branches. We're still opening branches in cities around the world. We've added 1,000 people in AI itself. We're adding people and data scientists. Journey to the cloud. We have 44,000 engineers. So I think what you're going to see is some down, some up. In general, if we're a growing company, I would expect to go up a little bit. In general.
Typically, the TechStars is a conference where a lot of founders start to test the waters for IPOs, right. Potentially look to go public. There's been a deterrence to really going public as quickly as in the past, particularly for tech companies, just because there's so much private capital out there. Do you still see that? Is that a structural change, or is that something that's cyclical, just having to do with rates?
It's a complicated subject. Yes, there's private capital, and I think it's a good thing that people can raise money in the private capital markets. But it's a little odd that, public markets are quite elevated and IPOs haven't gone up very much yet. So, but part of it is they have access to capital, part of it is they're waiting, part of it is they're reducing their own cash burn, they don't need as much cash. So it's a whole bunch of reasons why they're not going public. But I think eventually you do need healthy public markets to have people liquefy their positions, which all the venture capitalists, I just had lunch with a bunch of venture capitalists, they all are going to want to do and actually need to do at one point.
So do you expect that to pick up in the near future, or do you think it's going to remain muted for the foreseeable future?
I don't know. I honestly don't know. I think it may very well stay muted because markets may come down as opposed to just go up endlessly, and they may find other sources. So when I speak to a lot of private equity and private venture and stuff like that, they tell you they have more non-public sources. I do think it's very important that our policymakers understand, because even here in the United States, we've made it hard to go public. We've eliminated research on smaller companies. The costs are much higher. Those litigation expenses are higher. Filing with the SEC is higher. So I think it would be really incumbent upon us to try to make it easier and cheaper to go public. Allow more risk to be borne in the public markets, and we got to figure out a way to do that. And we actually have 10 takeaways from lunch, which I want to take a good look at.
So that raises a question of where people are going public. And we're here in London, which has lagged behind a number of other areas, particularly New York, and has lost clout in other areas too, especially since Brexit. Do you think that this is just a momentary blip, or do you think that just on a broader level, London is kind of losing a bit of its clout as a major financial center?
Yeah, so I think, first of all, I love the fact, if you listen to the current Labour government, they're talking about growth, investment, markets, capital markets, and they do need to do those things to help it recover. If they didn't do those things, no, I think it'll become more permanent. Then, a lot of people, they go to the United States, there's more liquidity. It's easy to do. I mean, or they have a lot of business there, which also making this a great business environment will also help companies going public here. But right now, the NASDAQ, the New York Stock Exchange, they're just more attractive places to go, and we'll see how that pans out. But I think it's important. We want to help them do better here. I'm not in favor of just advantaging the United States at the expense of Europe. But I do think that Europe needs to focus on, Mario Draghi's report. There are a lot of things in there that they need to do to get productivity back and growth back and markets back. They need the capital markets union, for example, which they've been talking about for years. They actually do really need it to foster growth around European countries.
On a broader level, just aside from the London market, what kind of activity do you see in the pipeline for fourth quarter? I mean, do you see a reluctance by companies to really engage with major actions because of the election, because of potential volatility, because of geopolitics, or do you see it really ramping up?
Yeah, so I've always, we always talk about backlogs, and I always tell my own people, be careful, because backlogs tend to grow and expand and stop. There's a pretty good backlog growing of IPOs of companies. Whether it happens or not is a different thing. And M&A, yes, I do believe, I can't prove it's more anecdotal, that it's tampered quite a bit by, not the election, maybe the election, but by rules and regulations. And we talked to a lot of boards of directors here, they talk about is the risk capital there? You can take the risk. They want to be very conservative. In the United States, it's more about, can you wait 18 to 24 months to close a deal? And that creates a lot of risk for a company, particularly if you go to banking. I know a lot of the banks, I think they should be allowed to do deals. They're very, very reluctant because they can't wait. One of the last bank deals in the United States took 3 years. And I think, if I remember correctly, there's a 90-day regulatory requirement. Well, obviously, that's not taking place anymore. And we do have to fix these things. You want an active, healthy M&A market.
Just quickly, if policy...
And they're not all bad for competition, even though I think it's true in certain cases. But, we've just become like an anti-M&A country, and that's a bad idea.
Okay, just let's say that there's somebody else in charge of the FTC, and there are some different kinds of rules and sticks that people have to advance over. How much consolidation do you expect in the banking industry?
So for the FTC, and I want to make very clear about this, they say to hammer everything's a nail. They're a little bit like that, but it doesn't mean they aren't right about certain things they say. I just want to separate that. Look, I think there are 4,000 banks in the United States. They're all in a different position. You could be a very profitable community bank. So I don't think the idea you have to merge is true. But if you're competing in a certain business for certain clients and certain sites, you may need economies of scale. And, they should determine. So you do need consolidation. A lot of the, mid-sized banks want to do it. They shouldn't be hampered. And they would tell you, if I can't do it, you're basically ceding the ground to J.P. Morgan. And I think that's unfair. They should be allowed to merge. Their boards of directors should be allowed to make that decision based on what they think is in the best interest of the shareholders. This notion that the government should get involved in every single little bank deal, I think, is just wrong. And, they're adding social values to everything they do. It should be about safety and soundness. And a board of directors that says we need to merge, we want to merge, probably means they're heading for a safer and sounder bank. That's their desire. You can give a lot of examples where it doesn't work. It doesn't mean it shouldn't be allowed. And I think we've got to be a little more open about letting these things take place and letting them take place quickly.
Aside from just some of the regulatory overhang, there is this question about how much, in general, the markets are going to open up, and a lot of that has to hinge on the economy. You mentioned earlier that you are more pessimistic about a soft landing. I think you gave it a 35% probability back in April. Do you still think that, or do you think that the probability has gone up with some of the good data that we've been getting?
No, and there's important. I'm not talking about forecasting 2025. And I just think there's a lot of moving parts, a lot of things in the future which are inflationary. These, the most important thing taking place is these wars overseas, geopolitics, the terrible humane suffering, but also a bunch of these countries acting in cahoots against Western interests, against Israel, against Ukraine, against the United States. And that's really serious. So I look at a long amount of serious things. Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. when you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that. When you think you know what a company's worth much more than the market might know.
That maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. You got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. Now, they should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there, there's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. Banks are, the big market makers are very constrained. Not today. We have this anomaly where JP Morgan is going to have $1 trillion of cash and unable to intermediate in treasury markets or repo markets completely conservatively because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for JP Morgan. I do think policymakers will get upset. They don't like seeing that type of thing. And I think there are fixes to it. And I think they start working those fixes today.
Something that you said about how markets sometimes don't respond until an event is there.
Commodity markets.
Commodity markets. Well,
so think of stock markets that are forecasting earnings and cash out 5 years and 10 years and always adjusting it. And they're buyers and sellers and, equity prices adjust. But if you look at commodity price action, while sometimes it's forecast in the future, it actually is looking at supply and demand today. So the most important thing is supply and demand today with some sentiment, some inventory, how quickly you can replace supply and demand. So all commodities are different, but think of the treasuries a little bit as a commodity.
Well, do you think that treasuries, especially if you look at it as a commodity, which is a wonderful way to look at it, that there is sort of a catalyst in the election with respect to realizing what the deficit could be?
Yeah, people are making charts of what everyone said and what it might mean for the deficit. What they said and what they actually do and actually happens are completely different things. I'm not going to worry about that. I think what you should worry about is the deficit today is 7% of GDP. When Volcker was around and we had very high inflation, it was 3.5%. The debt to GDP is 35% back then, 1982. It's 100% today. The deficits today, the biggest peacetime deficit we ever ran. Deficits by their nature are inflationary. And at one point we have to deal with this. I would beg the government to set up a powerful Simpson balls type of committee authorized by the Congress, up or down vote. It's probably the only way to do it. The other way to do it is wait until there's some kind of disaster in the market, and then you're kind of forced to do it at the wrong time. And I don't know when that might be. Will it happen next year? Probably not. But can America afford 120% debt to GDP? Probably. But should we wait for that hockey stick to start? I don't think so. I think it's just a bad way to run risk.
So you mentioned government. Libby Cantrell of PIMCO. She runs public policy over there. Every time she comes on, she tells us that when she talks to clients overseas, she has to tell them, no, Jamie Dimon still isn't running for president. You get that question so much. Does it annoy you or does it flatter you?
It's more annoying than not, because I can't run for president, and there was no opening. I mean, there's no way that it was even possible. So it's a little flattering, but I just want to help our government do the right stuff. I think there are a lot of things to do to make America far better off, and particularly because I've mentioned this many times, a lot of things we've done which I think are bad, whether you're Democrat or Republican, and we support, it's often done in the name of good, have hurt the lower 20%. They're dying younger, their income didn't go up for 20 years, they're the ones who have more crime in neighborhoods, their schools don't work. We should acknowledge that as citizens and do something about it. Like I said, a lot of policies put in place have the exact unintended consequence, and that's where they hurt. Like, for example, growing the economy well, the people that help the most at the lower end. And I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America.
You haven't endorsed a candidate, and I wonder why. Is it because you think, as the leader of a big company, you've got to work with anyone? Or is this just that you can't decide this particular time around? I will decide, okay, and I will vote. I reserve the right to do whatever I want. Okay, I'm a citizen. I can vote. I can say what I want, and stuff like that. I've never been in the practice of endorsing candidates, and so. But I'm thinking through what I want to say or do or something like that. In a recent Washington Post editorial that you wrote, you talked about how you think it would be important for the next president to have a private sector individual at the cabinet level to really advise.
Half.
Half?
Yeah.
Okay, which positions do you think should be?
I mean, look, I look at the government. The American public needs and deserves very competent, effective government. And if you go around, they don't believe that's what they have. And, so people have all these things the government should do, but a lot of the things the government does, it doesn't do particularly well. It does some things particularly well. It does a lot of things only the government can do. But we have to be, again, cold-blooded, clear-headed, pragmatic about what works and doesn't work. And over time, there have been less and less people in government who were in the real world. You may think whatever you want about, I'm not blaming economists or teachers or stuff like, or lifetime politicians. That's not the same thing. And there are lessons in the real world. Even FDR, when he's getting closer and closer to World War II and needed to start building tanks and bridges, he took the people he'd been excoriating for years, the heads of GM, GE, DuPont, and got them back. I need you to set up these production boards and grow do these things. So it's about growing the economy. It's not about putting business people there. I think we should insult each other as citizens, try to understand each other. And I think it'd be great if the next president, they really want to, what's that word they say, unify, put someone from the other party in your cabinet, which, by the way, is what Eisenhower did. And that whole op-ed kind of came out of Eisenhower. He got the right people there. They studied the issues. They got the policy right. He never blamed people. He never insulted people. He never, he was always civil, which I think is a better way to be. He didn't denigrate the country, didn't denigrate classes of people. And so I just think that's the better way to be. And it's a more unifying leadership than, yelling and screaming at each other. If someone theoretically were called upon as a business leader, would you suggest that they go? Yeah, it's up to them. I wouldn't suggest they go and not go. It's their life and how they think they contribute and stuff like that. So, a major focus for you in your recent letter to investors and just in interviews has been geopolitics, and the situation is pretty dire. And I wonder if what you're telling clients, what they're doing, how they're arranging in preparation for potential escalations in a whole bunch of different hotspots. Unfortunately, I go to a lot of things and people like, tell us the positive news. What's the good spin out there? I was getting to that. I don't do anything like that. The truth is the truth is the truth, and the truth today is pretty ugly. And we have this war now. Almost 1 million casualties in Ukraine. The Ukrainians say that 20,000 children have been kidnapped and sent to Russia. It's quite clear that Russia, Iran, and North Korea are acting in cahoots. That China isn't kind of part of that, but they're aiding and abetting Russia. China and Russia have spoken about dismantling the world order set up by America and the Allies after World War II, which have been quite successful in keeping peace. They want to do it differently, and that's their right. I don't think it's a good idea for the Western world. And of course, the terrorist acts in Israel is being attacked, basically on 3 or 4 sides. This is tough stuff. American warships are being attacked every day in the Red Sea. The head of the FBI just said the terrorist threats internally and externally to the United States have never been higher. I think there was a lesson on when Ukraine was invaded. The world isn't a safe place. We've got to get rid of the illusion it's safe and somehow peace is at hand. So we need a very strong military, which means we have to spend more money, at least every analysis I've ever seen for that. We need a very strong economy. We have to subordinate some of the stuff we do to national security. And we have to engage much better with allies in trade, finance, development finance, and things like that if you want to hold the world together. And so, yeah, I think this is the most important thing. For dwarfs whether we have a soft landing or a modest landing in the next 12 months. That, to me, as a business person, almost all of us in business have dealt with that many times. That is not a big deal.
I guess, how do you then advise a potential client about what national security is? Is it a car? Is it AI? I mean, basically, how do you prepare for the changing world that we live in?
Yeah, so this is a very important question. So first of all, in terms of managing risk, when you look at the potential outcomes, I mean, all business should look at a range of outcomes and try to be prepared for them, whether or not they think they're going to happen. And then, could war affect the global economy? Absolutely. It can cause inflation and no growth. It may have no effect, but you got to be prepared for those things. And then on strategy specifically, we've actually hired Paul Henley, a former U.S. Army National Intelligence guy, forming a group, working with our research people, internal people, to answer exactly those questions. What is national security? Jake Sullivan talks about the small garden with high fences. What's in the garden? What's related to the garden? How would you do that? A lot of companies are still looking at their own supply chains. They would say, no, I get these components from Mexico or Vietnam, but inside that component is a very important one from China. So it's going to take a while, but every country, if it's national security, has the right to say, this is what we're going to do to protect our national security. And so we need work to do. And then there's the related, I call it mercantilist behavior. People are getting upset at China about EVs and lithium and solar. If it's unfair competition, that's a different issue, but it also needs to be addressed.
Jamie Dimon, unfortunately, we're out of time. It has been a pleasure speaking with you. Thank you for taking the time with us. And now I'm going to throw it back to you.
All right, Lisa Abramowitz there speaking exclusively with Jamie Dimon. This is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently. differently in Europe because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from Orlando, Florida. It is the calm before the storm. Alex Steele and I, we are broadcasting live at the World Center Marriott at Commonwealth's National Conference for Financial Advisors. The theme for Commonwealth's 2024 National Conference is Find the Good. The future is now. This event's mission is to help advisors build a blueprint for their futures and for their clients. This is the 10th year that Bloomberg Radio has been broadcasting live from this conference, so we're glad that they have us back here. We're going to feature many of the speakers that are here at this conference here in Orlando over the next couple hours. We're going to start out this hour checking in with Enda Curran. He's a Bloomberg Global Economy reporter, get his thoughts on China and what is going on there. More stimulus is needed, say a lot of market watchers. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, is going to join us here and get us his thoughts on what he thinks his Federal Reserve is going to do. So we got a busy couple hours coming up from Orlando, Florida, before we try to get out of here this afternoon.
A lot of suitcases walking around right now.
What's that?
A lot of suitcases walking
You're exactly right.
The checkout line was real long this morning when I went to go
People
do that.
I think are getting out of Dodge. So we got a lot coming up over the next couple hours. Right now, let's go to Mr. John Tucker, King of Bloomberg Business.
All right, guys, the major stock averages, they are all higher right now. You have 8 of the 11 major industry groups in the S&P 500 up. Information technology, consumer discretionary, those are the best performing groups. And energy is the biggest drag right now as crude oil prices, they fall. Investors waiting for the next big data point. We're going to get that with the Consumer Price Index out on Thursday. And earnings season underway. Big banks open their books on Friday. PepsiCo shares this morning, they are up about 0.6%. They lowered their sales outlook for the year due in part to squeezed consumers. DocuSign shares, they're rising. The S&P Dow Jones indices said the e-signature company is going to join the S&P Midcap 400 Index before trading opens October 11th. And Nora's going to be along in just a minute with more on this, but Hindenburg Research short Roblox shares. Of course, the firm saying that on X today. And as we check treasuries, 2-year yield, that is unchanged, 3.98. The 10-year yield, 2 basis points higher, 4.05%. The S&P 500, 35 points higher in the early going, up 0.6%. We're at 57.31 on the index. The Dow Jones Industrial Average down 4 points right now, 41,944 all over the place. And the NASDAQ 100 up 198 points. That is a rise of 1%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Now back to the Commonwealth Conference live in Orlando. Paul and Alex, hope you make it out okay.
I actually saw some sun this morning.
I know.
Like, it was like, what is happening?
Exactly.
It's very strange. JT, we will see you tomorrow morning. We are seeing a rally now at the S&P. You see a straight line up. S&P up by 0.6% just over the last 15, 20 minutes. We will keep our eye on that. We want to keep our eye on some movers as well, as John Tucker was talking about with Roblox getting hit pretty hard. Nora Melinda is joining us to help break it down. Nora, what happened with Roblox and sort of what are the underlying issues here?
So, as you know, we did get this news that Hindenburg is saying that it's short the stock. We got that news this morning, and we are, as such, seeing shares slumping as much as 9.4% this morning. That's the lowest level since early August, and this is after the company is saying that Roblox has inflated key metrics and has alleged that it doesn't have sufficient safety screens to prevent pedophiles from using the platform. And Roblox, a spokesperson there, did say that we totally reject the claims made in this report. The authors are, quote, admittedly short sellers and have an agenda irrespective of the substance of Roblox's business model and results.
As a parent whose child does use Roblox,
What is it again?
I get scared. Oh, it's like a gaming platform.
Okay, gotcha.
Yeah.
Thank you.
But it's really creative, and you can kind of make your own things and stuff like that. Another headline here is that the Golden Dragon Index, that is also lower. This is that pure China play, right, Nora?
Exactly. I mean, we're seeing shares. I'm watching the Golden Dragon Index. It's down as much as 8.1% in trading today, and that's the biggest drop that we've seen intraday since October of 2022. Now, we obviously know that the entire China stimulus has been in focus as of last week, but right now they're tumbling after Beijing stopped short of launching more major stimulus, which disappointed traders that were expecting more fuel for a world-beating stock rally. And we're seeing a lot of shares falling in sympathy off of that news, and the Golden Dragon Index being one of them.
Okay, some more reporting on that, Alex, in just a moment. Enda Kern's going to join us, some Bloomberg Global Economy reporter on this story. My personal kind of China market proxy is Alibaba. You know, it's all over the country, and they do so many parts of the economy there. They touch so many consumers. It's up 7% today after having, it's up 42% year to date.
Yeah, and it was like nothing new, right? Like the agency that spoke couldn't actually unleash stimulus, but whatever they announced in terms of wouldn't it be cool if we did this didn't surprise, and there wasn't anything different that was talked about before. I'm really interested. I was reading up on this. Pfizer. So we heard, yesterday, activist investor takes a stake in Pfizer, and then I'm reading a lot about it today, Nora, and it just feels like Pfizer's already doing the stuff that it needs to do in order to right-size its business. So it's a little odd that an activist investor would go into a company that's already doing the things.
And I think that's a really good point, and there are analysts that have spoken to that idea as well. But I mean, we are looking at it on a broader scope. Year to date, we only have Pfizer shares up about 1.4% year to date. So as you mentioned, they are kind of putting in these things to get things moving. But I do think we're seeing this activist investor really stepping in to see if they can move the momentum forward. As you mentioned, we have Starboard Value that's taken a stake of about $1 billion in Pfizer, and they're seeking to spur a turnaround in the stock. Of course, we know this has really been a struggling giant here, but the exact plans of what Starboard intends to do still remain unclear. But we did find that investors and research analysts are pretty frustrated by the company's sustained post-pandemic concerns.
Well, the Wall Street Journal's got a great Heard on the Street article today, basically saying with Pfizer stock down more than 30% over the past 2 years, speculation is growing that Albert Bourla's position as CEO might be in jeopardy. So
yeah,
that's,
yeah. I mean, the big problem is they really overestimated their COVID-19 sales, and then they had to really sort of readjust to that, and that
definitely
it's been difficult, it seems, for Pfizer to recover from that part. All right, Nora, thanks a lot. We really appreciate it. Norma Linda, we'll check you out in the next hour as well. Norma Linda joining us from Bloomberg News. Let's stay on that China story for a moment. Bloomberg News, Enda Kern joins us now on China. So, Enda, you lived in China for many, many years. You are obviously have an economics background. What we heard out of China today felt a little same old, same old. These are the things that we normally seem to think about when it comes to China stimulus. Is that a fair assessment?
Yeah, good morning. I think they had raised expectations because the officials from the National Development Reform Commission said they were going to hold a press conference on the first Tuesday back after the week-long holiday. And given that last week and the week before we had news about pending China stimulus, then expectations were, wow, this might be the next leg. Here comes the government to explain things further and announce new measures. But what happened was they didn't announce any new measures. They spoke about bringing forward some spending, maybe $200 billion worth of spending, some support for businesses and for some support for the less privileged and poor in society, but not much by way of detail. And I think that lack of detail on the spending side is what disappointed markets and upended trading the way you saw it. But to be clear, though, what they did say was that they reaffirmed a commitment to meeting their 5% growth target. That might sound like nothing people living from overseas, but it does mean the government's going to hit that politically sensitive target at all costs, and that means that at the very least they will continue to support the economy. And remember, the 5% growth target for China is obviously slower than double digits a decade ago, but it's 5% on a much bigger base than it was a decade ago as well. So it's not nothing.
And in reality, I guess from a political standpoint, maybe from an economic standpoint, in reality, what can President Xi Jinping do in terms of fiscal stimulus?
Well, they have room, certainly room to borrow and spend at the central government level. Now, when you get into the local governments and the provinces, that's where a lot of the property stress is located. That's where the business model of selling land off to developers to raise finances, that seems to be broken at the moment. So that's where your debt pile is. But the central government has a lot of fiscal space, to use the jargon. They could intervene. They could start shoring up projects or recapitalizing the banks, which I have noted that in recent weeks, or make sure that they get those property construction sites finished. So there's a lot they could do. There's a feeling, though, that they're still being cautious because of the legacy of debt and leverage that was left by previous rounds of China stimulus, and not just the financial crisis, but also over the last decade or so. They don't want to go down that road again. And also there's a view that maybe they're holding their powder somewhat dry. They want to get past the US election and see what comes out of that, because that could also be material for China.
So to that point, the market reaction was quite swift. So the way you're talking about it is like, look, they're long-term strategic. They don't want to make any mistakes. They want to kind of see how the election pans out. Golden Dragon Index is down. Commodities are getting hit really hard. Paul was pointing out Alibaba's down by about 8%. That's a proxy for the China consumer. Is that market reaction legit? Like, does it measure up with what we actually heard in your experience in understanding Chinese economic policy?
Well, typically the top policymakers in China, markets are not necessarily their number one concern. That's a rough rule of thumb. But I think what happened over the past couple of weeks was China's economy had reached such a kind of a funk that when the officials came out with the measures that they did, which is bringing down borrowing costs, talking about putting money back into the banks, the measures they announced before the Chinese break, it heightened expectations that more money might be on the way, real fiscal spending, and that's when the markets went off in a tear. And now we've reached a point where, wait a minute, what exactly are they saying here? They're obviously putting support into the economy. They obviously want to hit that 5% growth target. That's a political target. But are they going to actually go out and borrow and spend more money, like real new money? We're not there yet. They may yet do. That announcement might yet be coming, but that's not the signal for now. I think that's where both the disappointment and the confusion has come into the market side of things. China's clearly not planning to rev things up the way they have in previous downturns. They're going to take their time working their way out of this.
And just real quickly, for me, it's the long-term issues with their population aging. I mean, some of those issues are just long-standing. I don't know how you get around those things.
Yeah, no, absolutely right. I mean, I should have mentioned the structural issues. You've got the demographics. You've got the long-term debt story. You've got the system of political control, which some people will argue will ultimately keep a cap on China's economic potential. That's a point of debate, but it's one of the structural challenges that people talk about, all of which is weighing on China's growth. So there's a view out there that over the past 4 decades, the low-hanging fruit was picked. China had a manufacturing export model. It was gangbusters. It all went well. Throw in a property boom to finish it off. But now we're at a point where, of course, making those gains so much harder, aging workforce, a lot of debt, and geopolitical tensions. It means the China story is going to be much more complicated in the years ahead.
All right, very good. Enda Curran, thank you so much for joining us. Enda Curran, Bloomberg Global Economy Reporter, giving us the latest on China. And for a New York audience, here's a headline that just shocks me as a New York sports fan. New York Jets fire head coach Robert Saleh. I mean, I don't think anybody saw that. There was some reported rift between him and the quarterback Aaron Rodgers. Was that enough to get the coach fired? I don't know. We'll have some more reporting on that.
How are the Jets doing?
A little disappointing, but still there. I mean, they're kind of, they're at 2-3. I don't know if Rich Truman were around. He'd correct me here. I don't know.
But like not enough to like warrant a...
No, they're fine. But again, there's been this reported rift between Aaron Rodgers, the Hall of Fame, soon-to-be Hall of Fame head quarterback, and their coach. So we'll have some more reporting on that. See if we can find a sports reporter rambling around Bloomberg somewhere. All right, let's switch gears. Go to Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist here. Ira, how do you think the Fed is feeling about kind of their efforts with the 50 basis point rate cut and kind of some of the economic data that's been coming in over the past couple of weeks?
Yeah, we've had a lot of speakers the last couple of days come out and say that they supported the 50 basis point rate cut. Clearly, the Fed was looking at some of the job numbers from before we got the September report, as well as some anecdotal evidence from some of the surveys like the Beige Book, which did show general weakness and was not particularly upbeat. So I think at this point, the Fed's saying, okay, like, look, we were right, like, the economy seems okay, but slowing. So, we can take out some of this tightness from the market, but we're not going to go at the 50 basis point pace. And that's been a consensus from just about all the speakers, because we've had, I think, about half a dozen speakers over the last 24 hours, and they've all been pretty much in line.
Mm-hmm. So, Ira, what also has been quite interesting is it's slowly, ever so slowly, the market's starting to price in potentially no cut in November. It's still really low percentage, but like that narrative now is coming back. Should there be a higher or lower percentage of that?
Yeah, so I would be surprised if they didn't cut in November, and I think that this is just a market overreaction. Remember, you had a lot of people who were in instruments like Fed funds futures, for example, who were thinking, oh, maybe there is a chance of a 50. They went 50 in September, maybe they'll go at a 50 basis point pace. And quite frankly, that was always the risk, right? Creating more market volatility by not going at a more, what Greenspan called a more measured pace. And by going 50, you had some people who were thinking, oh, the Fed sees something we don't, and they were kind of hedging the idea that there were more 50s in the cards. Now the market's pricing for a skip at some meeting, right? Not only November, but basically that the Fed may skip, say, go in November, then skip December, go January. That's starting to be priced into the market too. If you just look at some of the butterflies and how they're trading, butterflies meaning the November versus December versus January versus February kind of Fed funds futures. So I think that for me, I think that the Fed's going to keep going 25s, and because of that, the market kind of has to rethink, what does only going 25s mean?
What does only going 25s mean? How does the market rethink that?
Yeah, so I'm not sure about the equity market. I'm sure that some people will think that that's is going to be somewhat less accommodation. But for things like the Treasury curve, and we'll have more detail on this tomorrow. So as a little preview, without giving away too much, the Treasury curve had, after having steepened 130 basis points over the course of 6 months, has now reverted and it has come off the steepest levels that it's been. So I think number one is you do have a slower steepening of the yield curve than we've had in the very recent past, but you still have steepening and a steepening bias as long as the Fed keeps going. Still, the most important thing is not so much the pace, right? We're always focused on what's the next meeting, what's the next two meetings, but ultimately for where the 10-year yield ends up, whether it's going to end up at 4% or our year-end forecast, which is closer to 3.5%. Will the Federal Reserve, and what does the market price for the Federal Reserve to do in 2025? Will we end up at 4%? Will we end up at 3%? And we were at under 3% being priced for the end of 2025. Now that's back to almost 3.5%. And that's really been the big shift and one of the reasons why you've seen the sell-off in the long end of the curve.
Yeah, I'm looking to refinance the mortgage. You're not helping out much. I got the 10-year at 4.04%. So
you had like a moment.
I had a moment there. Ira had a moment. Ira Jersey, he's a chief U.S. interest rate strategist for Bloomberg Intelligence. We always appreciate getting a few minutes of his time here as we talk about the rate market. Coming up, Brad McMillan. He's a managing principal, wealth and investment management, and the CIO. So he's got a lot of jobs there. Commonwealth Financial Network. He's going to join us to discuss general market commentary and ways Commonwealth guides advisors during market fluctuation. So again, we've got over 2,000 financial advisors here in Orlando, Commonwealth, and we are here the calm before the storm. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, we have the major averages in the early going. They're mixed right now. The Dow Jones Industrial Average, 22 points lower. S&P 500 up 30 points, up 0.5% right now. The NASDAQ 100 up 174 points. That is a rise of about 0.9%. Roblox, responding to Hindenburg Research, the company says it firmly believes its gaming platform is safe and secure. They're rejecting claims made in Hindenburg's research report, saying they're misleading. Earlier in a post on X, Hindenburg Research said it's short of Roblox raising questions about the safety for kids who use the platform, among other things. And shares of Roblox right now, they're down just about 4%. PepsiCo trimming its revenue outlook for the year. They blame cash-strapped consumers, boycotts in the Middle East, and a major recall that hit volumes of its food and beverages. But PepsiCo shares right now up about 0.9%. And Honeywell planning to spin off its advanced materials division to create a business that could be worth as much as $10 billion. And shares of Honeywell International, a rise of 0.7%. As we look at yields right now, the 2-year down a basis point, 3.97. The 10-year yield is up 1 basis point, 4.04%. And just to recap that breaking sports news, Jets looking for a new coach, firing the head coach, Rob Saleh. That's according to ESPN. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right, JT, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We are live, broadcasting live in Orlando at the World Center Marriott. This place is huge, by the way. I mean,
how many steps did you clock yesterday?
15,000.
What?
Yeah. It's crazy, and that's, but I'm all over the theme parks. We're at Commonwealth's National Conference for Financial Advisors. They got like 2,000, 2,300 folks here. A lot of smart folks come in here trying to talk about the business and helping their clients with their financial advice. Brad McMillan joins us here today. He's a managing principal, wealth and investment management, and the CIO at Commonwealth Financial Network. Brad, aside from the coming hurricane, what are your registered investment advisors asking you at this conference this year? I mean, I know it's S&P's up 20%. I'm making money on my bonds, making money on my cash. It's probably a good time to be a financial advisor, but what are they asking you going forward?
Well, the real question is always what happens next, Paul. And, we've heard a lot of news. I mean, the hurricane coming in is a great kind of metaphor for impending doom. We've got wars.
I see blue skies, so there's something that there. But
a little bit of a mixed message. You get that right. But, so there's a lot of stuff that can go wrong. The Fed cut by 50 basis points. What do they know that we don't? So the question is, everything looks okay, but is it really? Is there a hurricane out there despite the blue skies we see? And I think the answer to that is actually things are okay. There's still a lot that can go wrong, and we need to keep an eye on it. But my talk this conference was actually going to be, it's going to be okay. And I think that's the real takeaway.
And to be fair, you were going to speak tomorrow, but you guys had to cancel the morning because of the hurricane. So if your talk is, it's stormy, but we're going to be okay, how is that reflected in a portfolio allocation?
Well, I think you can actually see it in what's happening in the market today. I mean, one of the things out there was we're going to have a recession. We've got to get defensive. We've got to go with value rather than growth. And that's not actually what we're seeing in the market today. We're seeing the NASDAQ outperforming, and we're seeing the Dow, which is relatively defensive, underperforming. Now, one day, of course, does not make a market. But the real message of the jobs report, as I read it, was that the economy is going to keep going. We're going to see earnings keep growing, and growth, you don't have to get defensive. There are still opportunities on the growth side going forward.
A lot of folks, when we saw their short-term rates go higher, I mean, you were able to get, I don't know if you're a Marcus customer, Goldman Sachs, you're able to get 5% on a money market or something
4.25 now.
4.25 now. How do you get your RAs, or what's the message for your RAs about, is it okay to be in cash, or you need to be in this market?
I think at this point, given where you're getting paid in the money markets, and in the bond market, depending, it's okay to sit out. There are opportunities out there, but you look at valuations, there are also risks. I mean, this is not a cloud-free sky. Go back to the weather metaphor. So, I look at this and I'm saying if I'm an older client or if I'm somebody who's really risk averse, I'm happy to sit at 4 or 5% and just take it easy. For the first time in a long time, bonds are actually worth being in for the return. Not great, but it's safe.
Right.
That's important.
To be fair, Paul, I am thinking about munis. Just
Okay.
so you know.
Little diversification.
That money
never
sitting
hurts.
in markets is, being very risk averse. I'm still thinking about it. So where does that leave? And you were mentioning sort of the cyclical versus value, et cetera, growth versus value, I should say. Where does that leave you in thinking about mid cap and small caps? Because if things are okay-ish, but there are worries, but we're okay, that's a really weird spot for the small caps.
It is a really weird spot, and I think when you look at that, you have to start thinking about sector exposure rather than, company size. And there's a lot of discussion out there about, we've got mid-cap, we've got small cap. I think you need to look at it. Okay, is it a financial? Well, they've been doing pretty well, and small cap or mid cap, that matters, but perhaps less than the fact that it's the financial sector or the industrial sector or whatever the sector exposure is. So I don't think it's a time for cap level discussion. I think it's time for sector exposure discussion.
What are some of the sectors that screen well for you guys?
Well, when you look at it, I think anything that's exposed to growth. You look at technology, one of the things we're seeing is companies are trying to manage their costs. I mean, one of the messages of the jobs report was that, no, we're not going to be able to hire lots of people cheaply. So any kind of technology that lets companies leverage capital expenditures rather than hiring, I think that's going to go. And that speaks directly to a lot of the mega cap stocks. It's probably a tailwind for the AI bubble. Excuse me, shouldn't have said bubble, but it's a tailwind for the AI industry. It's a tailwind for companies that really enable companies to do more with less. At the same time, I think when you look at that, that's also probably a tailwind for real estate because you got to put all these workers somewhere. And that indicates, along with, for example, Amazon going back to 5 days a week, we may be through the worst of it for the commercial real estate market. That may be early, I don't know, but you can see signs.
Well, we've been talking to a lot of commercial real estate people, and they've been saying something similar. Like, there's still going to be that 10% portion that's not great, but on the other hand, it's going to be okay. So, to your point about storms. So, when you take a look at that theme, though, there is a narrative out there that once we get past the election, you could see a lot of CapEx come into the market because one might think that there would be more clarity on, say, corporate taxes and tariffs. Do you see that as a headwind, tailwind for the economy? Or hope instead of reality?
I think it's more hope, but the thing I would say about that is we're already seeing massive investment. I mean, again, one of the things that's driving it is the demographics. We don't have enough workers. Yeah, the market is softened, so you're being forced to do capital investment. Regardless of who wins the election, you're going to have a situation where we're going to be continue to deglobalize. We're going to continue to restrict immigration. And that's going to require more capital investment. We are now in a position where we're generating most of the natural gas, which means an enormous amount of the chemicals industry is coming to the United States. And that requires massive capital investment. This is going to happen regardless of Washington.
So how do you discuss the political landscape, the election coming up this year? Because it's coming up in a matter of days, it seems like. I'm sure you're getting some questions, some comments from your financial advisors here.
One of the things that goes with my job is getting questions from people on both sides. And every single election cycle, I have people on both sides saying if the other side wins, it's going to be a disaster. And I've heard that for the past, 20 years I've been doing this, and it's always been wrong. One of the things that you have to remember as an investor is the U.S. economy is largely decoupled from Washington. Any effects it has at the margin.
But isn't that the irony, though? It's not, because of fiscal spend. So, like, a lot of the hiring is in government workers. Like, the money that's being pumped in is through government programs, et cetera. So, in a weird way, it's not.
But you're wrong, because...
How am I wrong?
That is a relatively small part of the economy, and that is
Federal workers?
Yeah.
Small part of the economy, and all the money...
Relatively small part, yes.
Okay.
And you look at all of the spend out there, and the question is, even if you're correct, is that going to change up or down significantly depending on the administration? It's not. they're not going to.
No, it's going to keep growing. And the budget fiscal deficits are going to grow. That's the
idea. Is that
idea.
a tailwind or a headwind for the economy?
You tell me.
It's a tailwind.
Okay.
As we've seen, I mean, one of the interesting things, and I'll go back to history a little bit, is you go back to the sequester and how that was supposed to cut spending and stop the growth of the deficit. You know what? It worked. So we've seen that before. When federal spending cuts, that slows growth down. But if you say that federal spending is going to increase, that is a tailwind for growth going forward.
So what do we do here if the Federal Reserve? I feel pretty comfortable that just that 50 basis points, and then they can kind of do their 25s as they like. I'm comfortable with that. Are you comfortable with that?
I think 50 basis points was a mistake.
Okay.
I was really surprised they did that. And the reason I was surprised is you've got two mandates, okay? You've got employment, which, as we've seen, slowed down a little bit, but is still at boom levels historically and is coming back up. And then you've got inflation, which is not where they want it to be. It's moving there. But then you look at the components, housing is not going to, I've been saying housing is going to, inflation is going to go down for the past 3 years. Guess what? It hasn't. And then you're going to have inflationary things like, reduced immigration. You look at wage growth, that's still up. So I think the Fed is going to end up having to reverse sometime in the next year or two.
You mean stop cutting or hiking?
Hiking.
Wow.
Okay, that would be huge. That would be a huge change for portfolio allocation for the whole thing. Yeah.
I think they made a mistake with the 50 basis points. But that said, when you look at it, why are they going to have to hike? It's going to be because growth continues, and that's actually going to be good for corporate earnings. And when you look at stock prices, they're in nominal terms. They're not in real terms. So actually, you get more of a headline return even as inflation continues to go up.
All right, very good. Appreciate it. Hopefully you guys have a good show for the remainder of the day here today before people look, I think, making an early exit. Brad McMillan, Managing Principal, Wealth and Investment Management, and CIO at Commonwealth Financial Networks. We're here at their conference in Orlando, Florida. They have over 2,000 of their financial folks down here talking about the markets.
Yeah.
Looking at the markets here, I mean, they're kind of struggling a little bit just to get a little bit of direction, I would say. We've kind of got a mix here. The S&P up 30 points, the Dow off 40 points, but the NASDAQ, that's up 172 points. That's 1% on the NASDAQ.
So it seems like I was reading some options reports earlier today that you get that CPI on Thursday, and then we're looking for an over 1% move for the S&P now. So that's kind of moving up a little bit. So that could wind up being a material risk event. Oh, my goodness, sports. One of the top red stories is about the Jets.
I'm on the NewYorkPost.com right now. Robert Saleh shockingly fired by Jets. 5 games into the season, 2-3 record. I guess the final straw was their game over in London this past weekend. Aaron Rodgers threw 3 interceptions. If the Post didn't see this coming, I didn't see it coming.
I mean, basically, when I'm reading it from our reporting, he had a 20-36 record as the team's head coach since being hired in 2021. That's not good?
No, and in fact, they are built to win the Super Bowl this year. That's it. And so being 2-3 and not a good-looking 2-3 is enough for them to say, we got to make a change now. That's the only way I think you can read into it. Again, their aspirations were to win the Super Bowl this year with Aaron Rodgers as their quarterback. And to be 2-3 at this point, and again, not looking particularly good at 2-3, I guess the folks in charge have said, let's make a big-time change. This is
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages, they are mixed right now. You have 8 of the 11 major industry groups in the S&P 500 higher. The information technology and communication services sectors, the best performing groups. Right now, energy, the biggest drag as crude oil drops. And investors waiting for the next big data point. We get that with the Consumer Price Index on Thursday. And earnings season, that's underway. Big banks are going to open their books on Friday. PepsiCo has lowered their sales outlook for the year. In part, they're blaming the squeezed consumers, but PepsiCo shares right now up about 0.9%. You also have DocuSign shares. They're rising as much as 8%. The S&P Dow Jones Indices said that the e-signature company will join the S&P Midcap 400 index before trading opens on October 11th. And Hindenburg Research says it is short Roblox. The firm announcing that on a post on X. Shares of Roblox, they are down 2.95%. The S&P 500 is up 35 points, a rise of 0.6% at 5730. The Dow Jones Industrial Average 12 points lower, and the Nasdaq 100 right now 204 points higher. That is up over 1% in today's trading. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, and we are broadcasting to you live from Orlando at the World Center Marriott at Commonwealth's National Conference for Financial Advisors. There are about 2,000 advisors over the last couple days getting expert guidance on how to manage their clients and their businesses. And the theme of the conference this year is The Future is Now. And this is the 10th year that Bloomberg Radio has been privileged to broadcast from the conference. Well, joining us now here is Rob Kane, Director of Alternative Investments over at Commonwealth Financial Network. Now, he joined back in July of 2013 as an alternative investment analyst. So this is great. So we just had a great conversation about the broader market and how to allocate, etc. Where do alternative investments come in? What's the right percentage?
You've got to look at alternatives through a holistic approach, in my view. And I always say, if you want to start with a nice allocation, about 10% to really move that portfolio. But I think you can make a good argument that 20, maybe even 25% for those higher net worth clients make a lot of sense. Once you start getting that endowment type model, unless you're able to source and you have that breadth and skill to get those types of investments, largely you're going to be paying up for beta exposure. So that's why we would say 30% is probably at the high end you want to be.
Where do I go? When growing up, it was just private equity, some hedge funds. Now private credit is a big source of capital.
Bitcoin, crypto.
Yeah, exactly. So how do you guys, I guess, ease your clients into, or ease your advisors into that space?
I think private credit is almost the path of least resistance because everyone understands the fixed income concept there. And the story makes a lot of sense because we've seen traditional lenders pull back here, the banks, given what's going on here. And these non-traditional lenders are just fueling the economy with this. At the end of the day, it's debt. We need to ensure that they're able to pay it back. And yes, we can command a premium for those types of returns, but we need to ensure that's going to come through. And that's looking at good quality managed to do that.
So when you're talking to clients, is it 50-40-10? Is it 60-30-10?
It all depends what the client's looking for. So those more aggressive type investors, you're going to want to pull from the equity bucket and look for return enhanced strategies such as private equity.
Okay.
On the fixed income side, I think it makes a lot of sense to use a private credit by pairing from your loans or your credit exposure in general. That will give you a nice balance. I would say that's where you want to start and almost look at the drivers of returns underneath, try to match those where your traditional betas and exposures are, and then put those alts in there.
What types of products do you guys at Commonwealth have for your RIAs?
Yeah, so we have private equity, have private credit, we have hedge funds. Right now, private equity is a big seller for us. A lot of folks are gravitating towards that story. We've also seen the decline in the public market opportunities, so it's a larger opportunity set for people to get into. We're seeing folks like that, particularly in the secondaries, private equity secondaries, where there's more clear insight into the portfolio, and the companies know what they need to get to that next level. Our advisors are really jumping up to that story.
That's interesting, and that's like a way for private equity to offload. So it's like definitely a burgeoning market. How do you think about the risks? one might say that retail being invested in, say, private credit has not been tested. Private credit's been around for a long time. It's been through cycles, but not with this kind of money and investor base. How do you think about the risks?
Well, I start with, you think about private credit, there's absolutely a ton of risk, and the biggest risk is default. Can I get my income back? But a lot of private credit managers are actually lending to private equity managers. So they're able to navigate these companies through those complex times by injecting equity in there. Also, the covenant protection in private credit, that's much stronger than you see in the syndicated market. And that makes it really healthy, and the recovery rate's a lot better in the long term.
All right, so how has it changed, really? I mean, we've been here for 10 years coming to your conference. 10 years ago versus today, how's the discussion? How's your role in terms of communicating with your RIAs here? I mean, I'm guessing they want to talk to you more often than they did 10 years ago.
It's funny. We joked that we were in the corner for a long time. No one wanted to talk alternatives, and then it became mainstream. We're having those conversations every day. Our advisors have really embraced it. We've seen those allocations increase significantly over the past few years, and then we had to meet that demand with product. So Commonwealth, we took a lot of time to increase our offering set for our advisors and give them everything that they need now. So we're very competitive in that space.
What do you think is the biggest misunderstanding when it comes to alternatives?
A lot of folks think alternatives. They think they see on the news these returns of 1,000+%. And I said, that's not your alternatives. The alternatives have a role in the portfolio, usually that uncorrelated or lack of correlation. They're not all return enhancers. And having that discussion, particularly when you're talking to clients as well, you got to have that discussion and frame that correctly.
So meaning that investors come to you and they're like, all right, let's use my portfolio by big time.
Exactly,
okay,
exactly.
We haven't seen a real, or maybe ask another way, have we seen, or are you concerned about seeing a big correction in private equity, in private credit, in hedge funds? We haven't really seen that, have we?
We haven't. You know, private credit is one area I'm staring at and seeing what's going on there. We have seen non-accruals and defaults start picking up a little bit. The interest rate cut will help that out. But if we start thinking about those lower middle market type of companies, they are highly indebted. The longer interest rates stay, the more they're going to struggle. And that's the concern that I'm watching. The upper market, these type of companies usually are more resilient, not tied to the economy like the lower middle market. So I'm not as worried about that, but lower middle market I am.
What other questions are you getting right now? Either from investors or from other RIAs?
Well, it's funny. A lot of people say, where do you go? And on one hand, I can make a strong argument where the economy is going, and it's we're going to go and look at the equity markets. We're going to perform very well. On the other hand, you can see a tiring economy. So a lot of people say, what do you do in this? So we're having discussions about absolute return hedge funds, really not making any directional bets here, just taking idiosyncratic ideas. Let's leverage those up a little bit and get those returns. And that's what we're having with those folks, having those discussions. Longer term, we are having that private equity discussion. And we're talking about the public markets declining, the opportunity set, where can you go? And private equity makes a lot of sense.
Crypto, is that in the conversation?
He didn't mention it. That's actually interesting. It's been how long?
Very episodic.
It's been like 10 minutes and you didn't say it.
It's very episodic. And when it comes, a lot of people will jump on there. But when they start seeing those swings, a lot of people think they have that stomach for that volatility, but at the end of the day, they truly don't. So we've seen that wane now.
What about gold? And yeah, let's start there, and then we can ask about real estate.
Yeah, I know. We do like gold. We're not gold bugs, so to speak. We think there makes a lot of sense there. And the one thing I always look at, if you look at the international buyers, they're going to jump in. So there's a supply-demand factor in there. Obviously, you have the interest rates that are tied in there. Gold has been on a great tear. We do think it makes a lot of sense in the portfolio still. And we have to look, there's a lot of volatility risks out there. So I think gold should stay in the portfolio for the long term.
All right, Rob, thank you so much for joining us. Really appreciate it. Rob Kane, he's the director, Alternative Investments at Commonwealth Financial Network. And Alex, I'm just looking at your crude oil. WTI crude oil, well, 4.5% here, just about $73.65. So a little bit of a pullback after the big run-up we've had.
I feel like it must be twofold. One is that it already had a big run. Yep. So if it hits certain levels, you can imagine that it's sort of ripe for a pullback. But also when you get that disappointing China data, when you have disappointing lack of Chinese stimulus and no concrete plans for people to put money in people's pockets to spend stuff, that's going to wind up affecting the market. There's still the geopolitical risks, though, so we can't understate that. Coming up, Sean Donnan is Bloomberg News senior economics writer. On our big take story today, it's how two towns have dealt with tariffs and what happens when China is hit with tariffs, what happens to those local economies. We're going to break it down. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Orlando at the World Center Marriott at Commonwealth's National Conference for Financial Advisors. The 10th year that Bloomberg Radio has been here, and the future is now. That is the topic of this year's conference. All right, we also want to take a look at the broader, the big take. They do a great job. They wind up breaking down some of the top stories that you need to know, and they do nice in-depth look at that. Now, today's big take story is how 2 U.S. towns show what happens when China gets hit with tariffs. And joining us now is Sean Donnan to break down that story. He's Bloomberg News senior economics writer. So tariffs on Chinese goods have been in place for a while. That was definitely something favored by President Trump specifically. So we do have years now that we can kind of look and measure the impact on U.S. counties. What did you notice?
Yeah, so as you say, the Trump administration put in place tariffs on a select group of imports from China in 2018. What we look at in this story is kind of an extreme example, and that is these are additional tariffs that were put in place on trailer chassis in 2021. Now, if you think of trailer chassis, these are the things that carry the containers that sit behind the big rigs on the highway. They're literally the kind of wheels that move goods around the country. And so it's a very isolated example of tariffs. But what's important here is it's not just about how the tariffs impacted imports, but it's also what happened to the companies. And we look at 2 companies after these tariffs went into place, and they ended up in what really is a tangled tale.
So what do we learn from these 2 small towns, Pittsview, Alabama, and Emporia, Virginia? What do they make, and what have the tariffs done to their businesses and to their towns?
Sure. So in Pittsview, Alabama is home to a place called, to a company called Pitts Enterprises, which lobbied for these tariffs to go into place in 2021 on trailer chassis from China. And in Emporia, Virginia, there's a small factory out on the outskirts of town that makes trailer chassis for a big Chinese company called CIMC. What we learn is really that it's never a simple story when tariffs go into place. After the tariffs went into place and this Chinese company could no longer import trailer chassis into the U.S. because it just wasn't cost effective, they shifted production to the United States. They did what President Trump wants companies to do, wants foreign companies to do, and that is if these tariffs go into place, to build factories here in the United States and start producing here. And so they started doing that. And also, Pitts Enterprises started ramping up production of these chassis. But at the same time, these tariffs going into place and the end of these imports coincided with, and you probably remember this, the supply chain mess of 2020 and 2021. And a real need for a lot of trailer chassis. And there was a shortage of trailer chassis at the time, so Pitts Enterprises decided that it would try to import some trailer chassis of its own from Vietnam. The problem was that those trailer chassis that it imported from Vietnam actually had a lot of Chinese parts. And so this company that had lobbied for these tariffs to go into place ended up finding these tariffs put in on these chassis that it wanted to import. And it then turned around with other U.S. producers and accused the Chinese company, CIMC, of not really producing these trailers in the United States and having lots of Chinese content there. And it ended up starting an investigation by the Customs and Border Protection agency that dragged on for more than a year, that ended up idling this production in Emporia, Virginia, and then another factory in California, which meant in the end that a few hundred people working for this Chinese company lost their jobs. The point is that when you have tariffs go into place, what often comes with them is these kind of messy commercial fights over who gets the benefit from the protection that you get from tariffs. And sometimes, as a result, you get people losing their jobs in these small towns in America.
So it's messy.
Yeah.
Who pays for it? If Paul and I want to buy a tractor, like, does that cost us more now?
Well, sure. So tariffs, economists will tell you that at the end of the day, tariffs are a kind of tax on imports that end up leading to higher prices that consumers pay for. Those trailer chassis now cost more in the United States than they did before these tariffs went into place. And that has an impact all through the supply chain and on the goods that end up at Walmart and Costco and so on, because they're carried by these trailer chassis.
All right, Sean, thanks so much for joining us. Sean Donnan, Bloomberg News senior economics writer on the big take story entitled Two U.S. Town Shows What Happens When China Gets Hit with Tariffs. And again, as Sean was just mentioning, a lot of economists do feel like tariffs, by and large, on average, are a tax on the end consumer. Yet, we certainly know that they are popular with President Trump, and they remained surprisingly popular with President Biden, who kept most of the Trump tariffs in place. And even Vice President Harris is saying tariffs are, in certain cases appropriate. So, seems to get some bipartisan support, even if the effects may not be.
I mean, it's like
intended to be.
How do you deglobalize something that's been globalized? It's tricky. It's going to take a long time. It's going to be a lot of snafus.
Yep.
And prices will go up.
Yep.
I mean, pretty big.
We all grew up with the globalization and
exactly.
how that was generally a good thing for global economies. Yes, a lot of folks in a lot of parts of the world, including the U.S. industrial base, were displaced to certain degrees. But again, trying to reshore, friendly shore a lot of those industries. We'll see how that plays out. We'll have more coming up. This is
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Orlando, from the World Center Marriott at Commonwealth National Conference for Financial Advisors. The 10th year that Bloomberg Radio has been broadcasting from here, although the conference tomorrow was canceled, so it kind of ends tonight
Cutting
because
it
of
short,
the
yep.
hurricane. Yeah, so that's a bummer. But we are here, and we're going to break down lots of fun topics over the next hour. We're going to talk to Peter Essel, SVP, Head of Advisory Solutions at Commonwealth. He'll talk about the market and the evolution of what portfolio management looks like and the platforms now that RIAs use. Plus, we will talk to Dan Williams, get the latest on what's happening in Israel. Plus, Karen Ubelhart will be about Honeywell spinning off its advanced materials division. Might not sound interesting, but it's really cool and doesn't actually provide a catalyst for Honeywell stock. So we'll break all that down in the next hour. But let's kick it off with a Bloomberg Business Flash. And for that, we go to John Tucker. John?
All right, Charlie Pellet here, handling things. We have got the Dow, the S&P, NASDAQ all advancing, with the Dow Jones Industrial Average up now by 36 points, up by about 0.1%. A rebound in the world's biggest tech companies driving stocks higher. NASDAQ up now by 224 points, up by 1.2%. S&P higher by 43, a gain of 0.8%. 10-year, 4.03%. The 2-year right now, 3.97%. Gold is falling $25 the ounce, 26.17, down by 1%. And West Texas Intermediate crude plunging 4.7%. WTI after yesterday's surge now at 73.48. Brent, the global benchmark, down 4.6%, 77.19 a barrel on Brent. So the Dow, the S&P, NASDAQ all surging. And right now we have got the 10-year again, bears repeating, 4.03%. Our Nora Melinda is going to have a whole lot more on the markets for us coming up in just a moment. J.P. Morgan Chase CEO Jamie Dimon, you heard him on Bloomberg Radio, says regulators in the U.S. and the U.K. should make it easier for companies to go public. And in a wide-ranging interview with Bloomberg's Lisa Abramowitz at the J.P. Morgan Techstars Conference in London, he also talked about the deal environment for banks.
In the United States, it's more about, can you wait 18 to 24 months to close a deal? And that creates a lot of risk for a company, particularly if you go to banking. I know a lot of the banks, I think they should be allowed to do deals. They're very, very reluctant because they can't wait. You know, one of the last bank deals in the United States took 3 years. And I think if I remember correctly, there's a 90-day regulatory requirement. Well, obviously that's not taking place anymore.
And in that conversation, Diamond also said he has yet to make a decision on whether to endorse a candidate in the presidential election in next month. Briefly, PepsiCo trimming its revenue outlook for the year. PepsiCo shares up 1.4%. Rival Coca-Cola up by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate that. As always, Alex Steele, Paul Sweeney, we are live here in Orlando at the World Center Marriott at Commonwealth National Conference for Financial Advisors. So we're going to be speaking to a couple of guests coming up in this hour from the Commonwealth family coming up in just moments here. But right now, let's get a look at what's happening in this market. We've got some green on the screen, as Charlie Pellet was just reporting, particularly in the tech-heavy NASDAQ up 1.3%. I see NVIDIA moving higher as well, so maybe those chip names coming back into focus here. Let's check out Norma Linda. She covers all the equity markets for Bloomberg News. Nora, what are you looking at?
Well, I'm keeping an eye on Honeywell shares. That's ticker HON. We're seeing shares climbing as much as 3.1%. And this is after news that the company will be planning a spinoff of its advanced materials division. And of course, we know this company has really been having a bunch of acquisitions in recent months. I mean, it took on a part of Carrier's unit purchase, and it also did have some sort of deal with CAES Systems Holdings. But this is a really big deal. I mean, we're seeing analysts are saying that this would be positive for the stock, and it does underscore that the board is energetically trying to improve the company's share price.
Yeah, and I should point out that this has been the thorn in Honeywell's side. Everyone asks them about them being a conglomerate and how they need to break up, and then you ask Honeywell, and they're like, no, we're good. Like, we need all these businesses. We feel strong in all our business segments. So we're going to break that down in just a second with Karen Ubelhart. What else are you looking at here? We were talking about China, of course, over the last few hours. You have commodities getting hit really hard. What's the feed through into the China equity market?
Yes, I mean, that's really been a topic of conversation for quite a while, from last week bleeding into this one. But the reason that we're watching it today is because the NASDAQ Golden Dragon Index, that's ticker HXC, those are U.S. Listed China stocks, they're tumbling after Beijing stopped short of launching more major stimulus, which is what traders were really expecting. So this is a huge disappointment for those who were looking for more fuel to a world-beating stock rally. We're seeing the NASDAQ Golden Dragon tumbling for its worst day in nearly 2 years. The index is down as much as 8.1% in trading as I've last checked. But I mean, as we're looking at it on a broader scale, we are seeing that index up as much as 17% year to date.
Wells Fargo, what's going on with our friends there?
Yes, definitely one to watch. I mean, I'm keeping an eye on Wells Fargo after Wolf rated it outperformed, and they're saying that all of the bad news is baked in. Of course, we know this stock has really been struggling since the end of the second quarter. There's been expectations for deeper rate cuts than we have received. And the analyst Stephen Chubak says that the downside risk to consensus is now more than reflected in the stock, and the valuation, quote, screens attractively. We're seeing shares of Wells Fargo, ticker WFC, climbing as much as 2%, but we are seeing those gains fading a bit here.
Of course, the issue for Wells Fargo is the asset cap. Like, until the asset cap gets moved, it's going to be really hard for them to compete and grow in a meaningful way to some of its peers, but yet they still got some more due diligence to do and more transparency to lift that asset cap. All right, Nora, thanks a lot. Really appreciate it. Norma Linda joining us in Bloomberg Studio. She covered equities for Bloomberg News. All right, let's go to geopolitics for a moment. Dan Williams is standing by as reporter based in Jerusalem. Israel's holding talks in Washington, and that's as the country is weighing how to respond to an Iranian missile attack about a week ago, and this comes as the year anniversary of what happened in Israel and Gaza. Okay, so Dan, where are we in terms of the actual talks? We kind of know where the military fighting is. What about the talks?
Well, Israel's Defense Minister Yoav Gallant will this evening set off for Washington for talks with his U.S. counterpart, Lloyd Austin, and also we hear other members of the Biden administration. This is an especially fraught period in this alliance because while the Biden administration has been very supportive of Israel's war effort in terms of supplying weaponry, moral support, diplomatic support, the sides have been locking horns at times about specific moves, including this move into Lebanon on the ground over the last week by the Israelis, including how Israel might carry out its threatened retaliation for Iran's 180 ballistic missiles that were fired also just a few days ago. So they're expected to discuss that, try to work out something they might agree on that the Americans would not see as needlessly rattling the region, perhaps setting off an energy shock and a major shipping crisis and terrorism crisis, just as the United States is in the last weeks of this election campaign ahead of the vote in November.
Should we be surprised, Dan, that Israel has not yet responded against Iran for that missile attack? I kind of thought we would have seen something by now.
That has been said. On the other hand, this is a pretty weighty period. Attacking Iran again, it's worth remembering that the Iranian ballistic missile salvo of last week was the second such attack by Iran. It conducted one in mid-April, to which Israel responded with a very low signature. In fact, the Israelis, to my knowledge, never acknowledged it. They somehow managed to get some kind of strike vehicle into Iran to hit a radar at a key airbase. But at the time, they kept it very low key. So the question is, would they do it again now, or would it have to be something pretty spectacular in order to register as a deterrent? Now, within Israel, there is open discussion of whether Israel should go all the way and strike Iran's nuclear facilities. This is something that's been threatened for years, never carried out. Or the oil facilities, or go for something more limited, military politics and all that. This is really not something anyone would enter into rashly. I think the Israelis will be very careful to keep the Americans on side. And that is the reason for this trip. And with the pace of this war, I imagine even if the attack is carried out today, next week, in a month, it'll still be seen as half of the course when it comes for this current standoff, or I should say face-off between Israel and Iran.
All right, Dan, we really appreciate it. Thank you very much. Dan Williams, reporter for Bloomberg News, based in Jerusalem, joining us there on the latest in Israel's response to that Iranian missile attack. Back to the markets, looking at Honeywell stock is up by over 1%. It's planning to spin off its advanced materials division that's as the conglomerate is trying to streamline its holdings. The only person to talk to in this situation, literally the only, is Karen Ubelhart, Bloomberg Intelligence Senior Industrials Analyst. Karen, I saw the headline and I was going to email you right away, and then I saw you were on the show, and I was like, cool, I won't bug her. I'm just going to ask her on the show. The big concern for Honeywell is that it's still one of the big industrial conglomerates and does a lot of stuff. And there's been so many calls to actually spin it off and trim it down. Is this enough? Is this a catalyst? Does this count?
It's big enough to count. I don't think it's big enough to, settle the question of should they have more focus. They've tried on the M&A side, which they were criticized for not doing any deals despite sitting on $10 to $12 billion in cash for a very long time. They've done 4 deals under the new CEO, one of them rather large. It's not moving the needle because acquisitions take time to tell you if they're successful or not, right? But they haven't done anything on the divestiture side since 2016 when they did the 2 spinoffs. So they were looking to do something. I thought they'd do something, but it had to be big. Is this big enough? No. But he did signal at a conference recently that if they didn't do something material by the end of this year, he'd be disappointed. So we knew something was coming. I don't know if this is enough.
So, I mean, Alex, no one on Global Wall Street has more experience with divestitures than Karen Ubelhart. She's been covering these industrial companies for decades, and they're always buying something or selling something. And the best example is GE. And it seems like GE has gotten to a spot where the market likes where they are and how they're positioned. Is Honeywell, Karen, trying to do something like GE?
To be fair, GE took a real long time.
A generation.
I said don't bet against Larry, but it took a very long time for it to work. So I don't think.
So is Honeywell in the same kind of strategy?
They have very good businesses. They were never in the trouble that GE was in, and they're one of the most profitable companies in the group. The problem is there's a lack of catalyst, number one, and number two, as we know, these things go in waves and people want focus now. I've said over the cycles, they break them all up, they put them back together. They break them all up. We're in the break them all up now. And a lot of the companies have really pared down, like the HVAC companies, for example. So people want something big. And the other point I'd say is they have, mediocre organic growth for a while now, but they always delivered on earnings. They missed for the first time in the last quarter, and that stock blew up because they don't miss. So, it's been an underperformer now on any time period you want to look, 1, 3, 5 years. And he's frustrated, you can tell. But I think there has to be something more.
What is Honeywell now? So if I was to go to you and be like, what do they do? What would be your answer?
The biggest business is aerospace. Very well positioned there. Very good business. Good long-term outlook. Building automation is a second one. The rest of the three are smaller. And that's a decent business. I don't think it's a particularly high grower, and they did a big acquisition there. The other third big business is automation, and it's factory industrial automation, process automation. It's warehouse automation, which has not worked out that well so far, and a few other bits and pieces. And the third piece is what remains of the chemical business, which is a catalyst business called UOP.
So, Karen, I know from reading your research and talking to you over the years, you got to get the right CEO in there to really get things done, because these are big lumbering companies. The CEO now, Vimal Kapur, has been in the role for a little more than a year, but he's been at Honeywell for a long time. What's the street feeling about him? Is he the guy who, like a Larry Culp, can get things done?
I think people were surprised, but took the change positively, because people had been frustrated that they sat on so much cash and probably didn't do anything with it, and people wanted bigger changes. So he took the first stab with all the acquisitions. I think operationally he does a great job. That's been the Honeywell story. I think we'll have to wait and see what else he does in the portfolio change. This is a decent size move, but it's only 10% of the company. So I'd say wait and see on that.
So for when we've talked in the past, it's really been that warehouse part of the business, because it's so very, very, very early cyclical, and that's been causing a lot of short-term pain. For that business, have we hit a trough? Like, is there a recovery in sight, or to buy the CEO some time?
It sounds like by the order pattern that things have troughed. There was an overbuild in warehouses, as we know, right? And then it collapsed. And they only got 1 or 2 good years out of that deal before it collapsed. They've structurally fixed it. The margins are not bad. It looks like it's troughed, but I don't think we're expecting a really big rebound. But one thing I will say that the CEO said, it's 4% of the company now, only because it shrunk so much. But we spend a lot more time than 4% of the time. That's because it's still not fixed. It needs volume. I thought that was when they might think about doing something with, but again, not enough to move the needle, and I'm not sure they're convinced it doesn't have a good long-term story. We're convinced, I think, in general.
What do you think about the dividend yield here, Karen? Dividend, 2.2% dividend yield. I got, $6-7 billion of free cash flow every year. Should they be paying more of a dividend, or do you think most investors are happy with a 2.2% dividend yield?
I think that's okay. I think they'd rather have them use the cash in a more, active way, like either more buybacks or more deals. So the question is, will they do anything with it when they get rid of this business, which is, will dilute earnings? I think they'll probably take the route of buyback and grow into the dividend. It's not going to be like it was with Emerson years ago, when the dividend was way too large after they sold a third of the company. I think they'll keep the dividend. I don't know that they'll grow it.
All right, Karen, we appreciate you. You are literally the smartest in the business on these topics. Karen Ubelhart, Bloomberg Intelligence Senior Industrials Analyst, joining us on Honeywell. That stock up by about 1%. So here's the funny thing. So NVIDIA is up over 3%. Yep. This is a big move for this stock to the upside. Apparently, Hon Hai Precision Industry plans to boost its server capacity to meet stronger than anticipated demand for NVIDIA. So get that derivative read-through to that continued strength. Again, poking little holes in those that poke the holes for the AI bubble at the end of the day.
We're seeing it in the broader markets. Alex, the S&P 500 up 0.7%, but the tech-heavy NASDAQ, if you will, up 1.1%, a little bit outperformance.
All right, coming up, we're going to talk to Peter Aselli. He is SVP, Head of Advisory Solutions at Commonwealth Financial Network. We're going to talk about the evolution of Commonwealth's discretionary portfolio management platform as we are live from Orlando. Our flight is at 3:05 p.m. today. Lots of people rolling around here with some rolly suitcases. We'll be right back after this. Happy Tuesday. This is Bloomberg Intelligence.